Good morning, everyone. Welcome to the third episode of Young and Leveraged. Today we will talk about BlackRock's latest acquisition of HPS Investment Partners. In our previous episode, we talked about the valuation aspect of this deal, and today we will focus more on the strategic part. We have three members of Young and Leveraged today. Durita will talk us through the deal structure. Laksha will take us through the rationale of this deal. And finally, we will have Mokshada, who will give us an outlook of how successful this deal would be. So without wasting further time, let's get straight into it. Durita, the BlackRock deal has been valued at $12 billion. So can you tell us a bit more about how the payment will be structured?
This headline figure of $12 billion is an all-equity transaction. So instead of paying in cash or taking on debt to finance this acquisition, BlackRock issued around 12.1 million subco units to HPS stakeholders, which are then convertible 1-to-1 into BlackRock shares. So about the payment structure, 9.2 million were delivered immediately at closing, and about 2.9 million units are deferred over 5 years and tied to service conditions. So essentially, if the recipient of these 2.9 million units leave this new subsidiary early, they will be forfeiting those units. So interestingly, this $12 billion price tag equates roughly to 30 times HPS's projected fee-related earning, or FRE. So in a nutshell, FRE is the steady recurring income HPS earns from management fees, which exclude certain bonuses. It's actually a key metric in valuing asset managers. You can think of it like the monthly subscription you pay for Netflix or Spotify. So for HPS, their subscribers are those big institutional investors paying management fees every year for HPS to manage their private credit investments. So at 30 times, BlackRock is paying quite a premium, but it is also signaling that BlackRock believes this acquisition will deliver long-term growth for them. Now, the base deal is 12 billion, but if certain performance milestones are met, there will be an additional 1.6 million earnout, which will then take the total to $13.7 billion.
Okay, that's an interesting way to structure the deal instead of paying cash to go with a percentage of shareholding. So my next question, I think BlackRock has pledged to cover the debts of HPS Investment Partners. And could you give us some more insights on that? And do you think covering the debts or refinancing it would entail a more successful deal at the end of it?
So indeed, BlackRock has committed to refinancing or retiring $400 million of debt as part of this deal. So obviously, this immediately bolsters HPS's balance sheet. So there will be no interest payments eating into their cash flow and no refinancing risk, which is quite important in today's environment where we have high interest rates. And it also frees up capital for growth, which is critical in the sphere of private credit, where speed and deal capacity are the essence. But we can also tie it to the earnout structure we talked about earlier. So by removing the debt, BlackRock is effectively clearing the runway for HPS to hit those milestones. So it's not just about risk reduction, but it's also setting the business up to achieve better performances, which of course benefits both parties.
Yes, thank you about that. And a last question now. I think our audience would be interested to know this, since marketing, I believe, is an important part of deals and mergers. Would HPS Investment Partners retain its branding, or would BlackRock give it a new name?
So actually no, and that's intentional. So Laksha can tell us more about it later, but HPS has a strong brand in the private credit landscape with some strong relationship and a distinct investment culture. So by keeping the brand and leadership intact, actually as a side note, the founders of HPS will be joining BlackRock's Global Executive Committee. So by keeping those aspects intact and placing them under a new division called Private Financing Solution, this allows BlackRock to benefit from HPS's reputation while also signaling to clients that the two are now aligned. So it's quite a smart move on BlackRock's part.
Yes, I can picture this now. Thank you very much, Durita. It was really insightful to talk about the deal structure with you. Now I think we can move on to Laksha, who will talk us through the rationale of the deal. So Laksha, why is BlackRock doing this?
Well, as you all know, every acquisition has a story. And in this case, it's all about BlackRock planting an even bigger flag in private markets. So by acquiring HPS for roughly 12 billion USD, BlackRock has instantly boosted its presence in private credit, a space that's been growing fast as investors look for higher returns outside traditional bonds and equities. Now, if you remember, they also bought Prekin last year for roughly 3.2 billion USD. Well, that wasn't just a random purchase. It gives BlackRock a world-class private market data, analytics, and research capabilities. Now, combined with HPS lending expertise, you have a one-stop shop for raising capital, managing deals, and delivering insights all under one roof.
Yes, so we can see that BlackRock really wants to capitalize on the private credit market. And according to you, what demarcates private credit from the traditional credit lending facilities?
Well, essentially, private credit enables borrowers to access capital with customized financing details that they might not otherwise would have been able to with traditional lenders and banks. Now, if you ask me, what is private credit and what makes it so different from traditional lending? Well, to put it in simple terms, you can think of it as loans made by investment firms and not by banks. These loans often go to mid-sized companies that need flexible terms or tailored financing. They are not traded on public markets, they are less liquid, and they come with higher yields, which is partly why they carry such high risk. Now, private credit also has some advantages over traditional banks. For instance, they are more flexible for borrowers and lenders to work towards customized solutions outside of traditional lending. Borrowers may also acquire loans and financing faster with traditional lending. Now, private credit deals are often subject to less oversight than other types of lending, while banks have more capital requirements and may face regulatory changes. So, in short, private credit skips the middleman and puts money directly into the hands of borrowers, which can be a win-win for both sides.
I believe as future workers ourselves, we will have to borrow money at some point, and maybe private credit will be our main option instead of more traditional retail lending ones. So, on this note, what do you think is the growth potential of private credit in the future, in the long run specifically?
I think you're totally right. Private credit isn't just an interesting corner of the market anymore. It's quickly becoming one of the main stages. So we are talking about a market that was around 1.5 trillion USD last year and is projected to hit roughly 2.6 trillion USD by the end of this decade. That's almost doubling in size in just a few years. Now you may ask why? Well, there's mainly two big forces. Firstly, traditional banks have pulled back from certain types of lending, especially of the tighter regulations, and this have left a funding gap. So private credit managers like HPS step right into that gap, offering quicker and more flexible financing. Secondly, investors are hunting for higher yields, and private credit often delivers exactly that, although with more risk. Now, here's when tricking comes in. In private market, information is gold, but it's also scarce. Pricking is one of the few treasure maps, if you may say so, in the market out there. So by owning that map, BlackRock can see where the best opportunities are, price risk more accurately, and even spot market trends before competitors do. So if you put those together, it's poised to be one of the biggest growth engines in asset management for the next decade. And BlackRock, with the data and the deal-making muscle, is positioning itself to be one of the central players in that story.
So, from what I've heard till now, I think BlackRock has made a good acquisition. So, concerning the stakeholders, who are the main stakeholders to be impacted by this deal, and what will the impacts look like?
Yes, so talking about the stakeholders, firstly, you have to mention the shareholders. As we all know, they're getting access to new growth engines. The Brooklyn deal alone is expected to deliver an internal rate of return of about 18%, although short-term earnings may take a slight dip. If you talk about institutional clients, well, they'll get better data, more product options, and streamlined tools, especially as breaking analytics get integrated into BlackRock's Aladdin platform, which is a software for portfolio management. Now, for HPS and Breaking employees, they'll definitely get access to global resources, but it's worth mentioning that they may face some challenges into integrating into a giant like BlackRock. Now, for competitors, they'll be staring at a more dominant player in private markets, and regulators will most probably keep a close eye on BlackRock. So, as a last word, looking at the big picture, it isn't just about one acquisition. It's about BlackRock building an end-to-end private market empire where they control the investment capital, the lending expertise, and the data to power it all. Now, whether this becomes a game-changing growth story or a complex integration challenge, that's what we'll be watching in the months ahead, and Mokshada will tell us more about it. Thank you.
Yes, thank you, Leksha. I think now we can comprehend really well what BlackRock is trying to achieve here with this deal. And yeah, thanks for all the insights. Now that this acquisition is sealed, I am certain that BlackRock has established some key targets to assess their growth for the coming years. Mukshada, can you tell us a bit more about these specific targets?
Yeah, for sure. So I'll just be building upon what Juita and Laksha said. Uh, Basically, what BlackRock has laid out of its targets by 2030 is they want to raise $400 billion in private markets capital. Not only that, they want to boost annual revenue from $20 billion to $35 billion. They also want to grow their organic base fee revenues by 5% or more per year, while keeping operating margins above 45%. Last but not least, they want to double the share revenue from private assets and technology from 15 to 30%. So these are the main targets. So if they want to reach anywhere near that, or if they know they're going to reach anywhere near that, that's just a sign that they're getting really close to their success.
Absolutely. Now, what are the positives you have analyzed that could lead to these targets being met?
So yeah, the thing is, first off, you have the dominance in the private credit market. So the acquisition, as you can see, instantly pushes BlackRock into the top tier of private credit managers. How is it doing that? It's combining its existing private credit business with HPS. BlackRock now manages roughly $238 billion in client assets in this space. That's huge. And as you know, it puts them right up there with heavyweights like Apollo and KKR in a market that's growing fast. That is not the only positive. The second thing that you can see is it isn't just about size. BlackRock's launching something called the Private Financing Solutions, the PFS in short. Think of it as a bridge between the $3 trillion public fixed income business and HPS deep expertise in private credit. For large institutional investors like insurance companies and pensions, this means one-stop shopping for both public and private credit solutions. That's a big cross-selling opportunity right there. Now, thirdly, financially, this is a smart diversification play. BlackRock's been looking to reduce its dependence on its lower margin ETF business. The deal is expected to boost its private markets fee-paying assets under management by 40% and management fees by 35%. So here's another smart move as well. BlackRock is keeping HPS leadership and investment teams in place, tying a big part of the payout to long-term performance, and that should help avoid the dreaded brain drain and keep HPS's winning formula.
Yeah, this deal sounds really optimistic from what we've spoken till now, but let's not be too optimistic about the future, since the troubling fact with M&As is actually that most of them fail to deliver what they promised. I was researching a bit about that, and I found a research by Harvard Business Review that made an estimation that between 70% and 90% of M&As fail. That's quite troubling, actually. And my question then is, what are the factors at play that could actually jeopardize this deal?
Yeah, that's actually astonishing. I'm learning new facts from you, actually. So there are definitely challenges. No deal is without its risk. So when you're telling me that, what I know about this whole deal, maybe some challenges linked to it, is that first off, merging two large organizations with different cultures is tricky. So Even if HPS keeps its brands, integrating operations like digital mention, technology, and compliance processes could get messy. Now, that's not the only thing. As you know, there's market volatility, and private credit can be a high risk, high reward game. So, if the economy takes a sharp downturn and borrowers start defaulting, returns could drop fast, and that would hit BlackRock's financials. Not only that, competition is also heating up. Apollo, Blackstone, KKR, they're all expanding aggressively. BlackRock will have to prove its platform offers something better, exceptional to keep attracting investor money. And we can't forget regulatory risk. The bigger you get, the more eyes on you. That's very obvious. Regulators could raise concerns about systemic risk or market concentration, whatever you want to call it, which might lead to new rules or higher compliance costs. And again, a final part of it, there's the question of performance. HPS has a strong track record, but success under new ownership is never guaranteed. If the combined entity doesn't deliver on its promises, that $12 billion price tag could start to look steep and investors might react accordingly. Let me just dive into a bit of the technical part of it if you don't mind. So what we need to remember here, which is associated with the risk and all, historically, private credit inflows at BlackRock have been very modest. That is just $9 billion in 2024, compared to $641 billion in total net flows across all strategies. And of course, while markets are hot, meaning they are expected to triple from $1.6 trillion to over $4.5 trillion by 2030, firms like Apollo, Blackstone, and Ares are already well ahead, managing between $300 and $600 billion each in private credit. So, as you can see, BlackRock is kind of lagging behind, but we can give it the benefit of the doubt for the time being, since it just started this acquisition, if you get what I mean.
Yeah, a last question for you. What's your personal take? Will it be a success or a failure since you are doing the outlook?
Yeah, so basically, first off, BlackRock's goals are very bold, no doubt about that. But they're not a pie in the sky. The firm has a proven growth engine, strong inflows, disciplined margins, and now more skill in private credit and tech solutions. But the next 5 years will be about execution. That is whether BlackRock can fully integrate these acquisitions, ramp up origination in private credit, and capture higher margin business without hitting regulatory or operational roadblocks. So, final words. The overall success of this acquisition will depend on BlackRock's ability to navigate these challenges and leverage the combined strength of both firms to deliver on its ambitious vision.
Good point. Yeah, we should all execute things, not just talk.
Yeah, perfectly said.
Yeah. On that note, I think we have touched every aspect of this deal, so I hope the audience has enjoyed it and hopefully we have enlightened you a bit more today. And yeah, we welcome you for our future episodes to keep watching. And until next time, goodbye. Thank you.